Good morning, agents. Welcome to Rob's Monday Mortgage Minute. I'm Rob Warner with Consumer First Financial, formerly with Chase Bank up here in the White Mountains for the past 2 years. And previous to that, a 30-year career of mortgage lending, both as an independent mortgage broker, mortgage banker, and worked for some major banks in my career. So I've seen a lot of ups and downs over my past 32 plus years of doing mortgage lending. I want to take a few minutes to go over some significant changes that are going on in the mortgage market today due to the coronavirus. And before I even get started, I'll let you know that the Federal Reserve announced that they will continue to purchase mortgage-backed securities to increase money supply for the mortgage industry right now. As many of you know, mortgage rates have been all over the place in the last 2 weeks. So hopefully we're going to see those stabilize out now. That being said, let me do a quick overview of the market, just so you kind of know where I'm coming from on these changes. Number one, the mortgage market in the U.S. is valued about $11 trillion. Number two, since 2007, FHA's portfolio has tripled in value to almost $1.2 trillion. And in November of 2019, FHA reported that 27% of borrowers spent more than half their incomes on debt. And also last year, loans 30 days or more past due amounted to 8% of their portfolio. So there's a major unknown coming our way right now because of many people being out of work due to the coronavirus, which segues me into this next subject, some government changes with government lending. I want to preface that these changes don't apply across the board to every lender right now, but lenders are overlaying their existing underwriting guidelines with some changes just to protect the risk on their loans. So you can expect FHA, VA, and USDA probably to make some changes shortly. So check with your lender if you have a borrower that you have been pre-qualified like over 3 weeks ago, and make sure that nothing's changed on that pre-qual before you submit an offer, because it might have changed and they may have to use another lender or structure the loan differently. So government overlays, FHA, VA, and USDA, minimum FICO scores are now going to be 640. Now, previously we had FHA loans down in the 500s we could do, but the risk is too great right now in that portfolio, so lenders are going to cap it at, or make the minimum 640. And then FICO scores between 640 and 659, and also using gift funds are going to require 6 months reserves. On VA loans, if you have residual income in excess of 120% of the VA required residual, then you'll be good to go. You won't need the reserves. Some other significant changes: the maximum debt to income ratio. Loans with debt to income ratios greater than 50% are going to require a minimum of 700 FICO score or 6 months reserves. We're still talking about government loans, by the way. And loans with debt to income ratios greater than 45% and FICOs less than 660 will require 6 months reserves. Or the VA loans will allow you to have income in excess of 120% of the VA residual requirement, will qualify with that. Anyway, let's talk about assets real quick. If reserves are needed, asset statements must be dated within 30 days of the note date. What does that mean? That means if in December of last year you have a quarterly statement on a borrower that has a stock fund or a retirement account that they're using for reserves, we're now going to need a more recent statement. And because the stock market took some major fluctuations, lenders are going to want to double check they still have enough money in there for reserves. So it's something to be aware of. And then income, still government loans, self-employed income or 1099 income, the income will be reduced by 25% to account for a disruption in the business, unless the borrower can document 12 months reserves. So once again, self-employed borrowers are a big risk. Lenders want to make sure, because of this disruption due to the coronavirus, that income is going to continue. So they can still use gift funds, so if they have a relative that can supply the 12 months reserves, they should be good to go in case they don't have it on their own. Let's talk about a major guideline change with conventional loans. Once again, these are overlays. Not every lender may have these yet. But non-owner occupied purchases, those loans are going to require 6 months reserves for the subject property and each other property the borrower may own. This is significant, so you want to double check it. Unless the borrower can qualify, has enough income to qualify without rental income on the subject or on other rental properties they own, then they won't need that reserve. but this is a biggie. I want to go over some lender credits real quick. Lender credits, as you well know, previous to a couple weeks ago, you could actually price a loan, 0.5%, 0.75% higher in rate and get a substantial lender credit to help toward closing costs. This applies to any government loan and conventional loan. Those lender credits are going away now. They're going to be very minute. Why? The reason is because if a lender gives out a $3,000 or $4,000 lender credit, and then 3 months from now the rates fall another 0.75%, 0.5%, the borrower is going to refinance that loan out of their lender, is going to be paid off. They're going to lose money on the loan because they gave out a big lender credit. So lender credits are going away. The range of rates now is going to be very narrow. It's only going to be like a 0.5% swing from the lowest rate to the highest rate. It's just going to be a narrow margin right now because lenders don't want the risk of early payoffs because it hurts their portfolio. So we're going to be back needing seller credits again, okay? Just be prepared that sellers are going to have to ante up some money toward closing costs on borrowers, maybe first-time buyers, people that don't have reserves, because they're going to be needing help. All right, so another guideline change, not really a guideline change, but Fannie Mae, I have some mortgage letters here Fannie Mae did on the 23rd of this month, and basically their main concern is continuity of income. So they're going to want the lenders to verify employment very close to the close of escrow to make sure the borrower is still on the job. And so if you have a borrower, I had heard of a story just recently where a borrower fell out of escrow because they called the employer to verify employment. They said, oh yeah, he's still employed by us, but we're temporarily closed due to the coronavirus. Well, that loan fell apart right there and then because they don't know when they're going to reopen their doors. So it's very important you make sure your borrower is still going to be on the job. Okay, verbal verifications of employment, in other words. What else did I want to cover real quick? Oh, appraisals. Fannie Mae and Freddie Mac both have basically allowing like drive-by appraisals or basically exterior only appraisals or a full appraisal. It's going to be up to the appraiser which one can be used. If it's a tricky property up here in the White Mountains, it's hard to comp out, it's probably going to need a full appraisal. But they're laxing their guidelines on them, and if the loan qualifies for a property inspection waiver, they're still honoring those. Meaning if I run your loan through the desktop underwriter system and it doesn't ask for an appraisal, then we're good to go. We don't need an appraisal. So I think I've covered everything. In closing, I'm Rob Warner again with Consumer First Financial. My NMLS number is 825102 and my cell number is 530 area code 391-1554. Remember, be safe and please don't hesitate to call me if you have any questions. Make it a great week.